Hello everyone, welcome back to Fundrise Finance. In today's video, we are going to talk about innovation and ARK Invest in particular, which has been popular due to its CEO and CIO, Cathie Wood, who became the darling of stock market since the coronavirus pandemic began in early 2020. Let's check it out. One major thing the stock market observed since pandemic started in early 2020 was the involvement of retail investors. Many such investors began their investing journey without much knowledge of the market and were swayed by whatever they felt was the most attractive stock at the time. At the same time, Cathie Wood of ARK Invest became prominent on the Wall Street thanks to her bold stock picks in the funds she ran, like Tesla, Zoom, Teladoc, Roku, etc. Thanks to the actions taken by the Fed in those testing times, liquidity was abundant and inflation was very low. Almost all of the stocks in Cathie Wood's ARK funds gave stellar returns, thus gaining her more and more status equivalent to the legendary Warren Buffett. Her flagship fund, the ARK Innovation ETF (ARKK), became synonymous with disruptive technology and innovation. Institutional and retail investors, who at the time were looking for anything and everything flashy, just kept buying up her funds left, right, and center, thus making the ARK funds swell up in assets managed. Investors used to track the firm's buys and sells on day-to-day basis to replicate them in their portfolio. Most such companies thrived in the low inflationary environment where the yields were low and money was easy to come. But as the pandemic rolled into its second year in 2021, the tides were slowly turning for all such stocks. Vaccines began coming into picture. Work from home stocks like Zoom, Roku, and Teladoc, to name a few, began to recede. Starting in February of 2021, when the ARK funds reached their all time highs, we can see them gradually lose their sheen. As the year started to close, we could hear the Fed turning more hawkish in their tone of stopping all the favors they had done to the market. Inflation was creeping up, yields were going high. Result of all such events was the massive decline in the high PE stocks starting November of 2021. Nasdaq, which is home to most of the technological companies, is in bear market currently. S&P 500 has entered correction territory. With all such events going on, one could think Cathie would be more sensible in her thought process. But in her latest interview on CNBC last week, her thoughts on the current situation made no sense to me. Here, let us go over the interview transcript for a few key portions that I wanted to discuss. Here, Cathie Wood admits that they had a significant decline over the past year. So from February 12th of last year till January 27th of this year, which is when they believe was when the market bottomed out, there was a 57% drop. But in the next line, we can see that they are saying that the depths of coronavirus in early 2020 till that particular all-time high, it was a 358% increase. So what Cathie Wood is mentioning is that from the depths of the market in the pandemic early stages, that was like in March of 2020, from then till the peak on February 12th, we can see the fund giving almost 300+%. But from then till January 27th is when they believe the market bottomed out. It is minus 56%. But from then till now, we can see few more weeks and it has dropped 5 more percent, like almost 60% drop in just over a year. So basically, if we look the overall fund performance from that March 20th of 2020 till now, what Cathie Wood is claiming is that their fund has done extremely well, which has given them over 67% of performance. So investors in her funds who would have started buying up sometime during, let's say, July or August of 2020, they're already seeing 20% of losses. And if somebody was buying up at their all-time highs, they're already sitting on 60% paper loss. One other thing that Cathie Wood mentioned in this interview was the benchmarks are a risk to innovative investing. So she claims active investing always trumps out the passive investing, but I'm not a firm believer of that thought process. When we compare the ARK fund with an S&P 500 index, we see over the last year, the ARK fund which has dropped almost 55%, whereas the S&P 500 index, which is just an index of 500 companies, has given almost 11% performance. In the entire interview, the stand Cathie Wood takes is that all the companies that have lost almost up to 60, 70, or even 80% in the last few months, she thinks all such companies will be able to make up for it and go beyond their all-time highs. That's where I felt the entire thought process of ARK Invest firm is not on the right path. Her reluctance to embrace the fact that the low inflationary environment is no longer present. Money is not so easy to come by for all such companies that she owns. With all these factors in place, I can't understand how they can keep telling the same thing over and over that they have a 5-year time horizon, five platforms, 14 technologies, the same thing over and over and over. Now, Cathie Wood, mind you, is a very good marketing person for her funds, for her company, but expecting people to keep trust and her firm and her funds is not going to work out anymore. Her reluctance to acknowledge the fact that the market is supported by the biggest innovative companies like Microsoft, Apple, Amazon, Google, who keep innovating day in and day out. But you find none of these companies in any of our funds. So I'm not a guy to forecast how the market would look like in the near term or long term, but one should be very cautious in placing their money into such funds whose thought process is very stubborn.